Hey guys, give me the next couple of minutes of your time and I'll explain why I think Global E, ticker GLBE, is an undervalued growth stock ready to explode. Real quick on what they do. Basically, they provide a simplified solutions to e-commerce stores that brand and buy and sell things internationally. So these next couple of slides I'm taking from are from the Global Investor Day presentation here in 2025, Global E. And it's just interesting to show that they're expanding into e-commerce and how painful it is. So you can see here with the example country, not only is there a language barrier, but there's currency barriers between what types of currency people transact in, the payment methods that are accepted because no one's using cash these days, the shipping method on how it's delivered, then the duties tax that you have to account for, when doing business in another country and state to state. So basically, what they're trying to demonstrate is that direct to customer expansion is nearly impossible once you start to go international without undertaking a lot of work. Going over the same points from last time here. The language, the currency, the payments, the shipping, the duty, just looking through all the different countries. One size does not fit all in every country, and it can be an unbelievable headache. So what is globally, what's their role here? Essentially, they've rounded up all of the data and everything needed and know the ins and outs of how to do and transact in every country, including the new tariffs, which, is a big boom for business recently. And basically, they're able to funnel it all into one single integration, a much better, smoother experience, not multiple payments, one payment provider. There's currency and hedging when you're dealing with the international, fulfillment and returns when we're talking e-commerce, fraud management, demand generation, a big one here, compliance, duty and tax management. It's all a headache and they simplify it into one app, which is beautiful. Digging a little more under the hood here into the nitty gritty, they provide some cool services like local messaging, local pricing, local payment methods. You can keep on going through just some very interesting services to really simplify the overall process. Yeah, and just to highlight a couple, interesting partnerships they've already landed here, Michael Kors, Marc Jacobs, Disney, Adidas, Victoria's Secret, Hugo Boss, Ralph Lauren, Versace, basically Givenchy, wherever basically they do a lot of international business, they seem to secure up some very large clients so far. And one thing I really like about the company here is that they're continuously spending in R&D. They look at the exponential gain here from 15 to million to 105 million, near 7x growth in 5 years to really make sure that they stay atop on everything they need from every country and understand the ins and outs of how to transact in that country. So here are kind of just three ratios that show how strong the company has been fundamentally over the past several years since 2018 here all the way up to expected 2027. Here's the last 12 months where we are right about now. You can see here is the free cash flow margin 17.7 up from minus 8.1%. The LTM is about break even, slightly downward here on the earnings per share, but it was minus 60 cents a share, so it improved quite considerably and anticipated to go up to $1.40 a share. But the real story I wanted to get to is, I mean, they are a free cash flow generating monster. And you'll see that on the next slide. But I mean, look at the free cash flow it's able to generate and churn out and what it's projected to going forward. I mean, on a free cash flow basis, they've been positive for quite some time, and we'll see that on the next page. And that's the heartbeat of the company. If you're not generating cash flow, you have to live off of debt, and generating this type of cash flow this early is pretty impressive. Here I got the income statement for 2020 through the LTMs, or for the last 5 years essentially. You can see revenue absolutely skyrocket. They bring out the change, year over year, 80% in 21, 67% in 22, 40% in 23, 32% in 2024, and you'll see the projections are still well in the 30% for some time to go. And I believe it's also going to be bolstered by the tariffs. That's adding a whole other, segment in now that they didn't exist before. You'll see everything in red. I'm not going to go over it here. A lot of it is R&D expenses that are hitting them hard right now. But on a free cash flow basis, none of this matters, right? We don't look at made up depreciation expenses. We look at what actually came through the door from net cash from operations, and then we'll take out capital expenditures. This website already does it. It's ticker.com. It's actually really nice. It's free too. You just sign up. You don't get all the data. You can see these lock points. But anyway, it's really cool. And we'll hop into the balance sheet, and then I want to show you the cash flow statement, which is very, very interesting. Company's balance sheet is incredibly healthy. I mean, I honestly, at this point, think they should, once the free cash flow solidifies permanently, they should start taking out some debt to lower their cost of capital at this point. But I mean, just take a look here. 515 million here in cash and short-term investments. The bulk of the rest of it is basically in goodwill, which is, intangible in nature. There's nothing really behind that number. um, for total assets of about 1.2 billion. They only have liabilities of 300 million. I mean, they have some solid balance sheet and room to run here and some debt to take out if they want. I know everyone hates the cash flow statement, at least that I talk to, but this is the example why it's so important because you can remember seeing all red everywhere before, but when you kind of digest it and get rid of the accounting foolery and look at things from a real financial lens, in my opinion, the cash flow from operations here is the best metric to look at next to free cash flow. Free cash flow is king, right? But cash flow from operations really just looks at from an operational perspective, were they profitable or not? And if you look at the income statement, it can kind of be misleading. I'm sure you've heard about EBITDA too as well. It can be inflated, adjusted. It's a nightmare, but always come to the cash flow statement. You can check out here cash flow from operations and free cash flow. If you look on a free cash flow basis, I mean they're chugging on along here. I mean they have free cash flow margins ranging from 6% was their absolute low. I mean now they're from well within 17 to 20% here, which you'll see will come through in our projections on the next slide. So real quick, here's a summarized DCF. One day I can take you through the larger model, but I don't want to torture myself or anyone, especially when we can get basically the same exact answer with much shorter inputs here. Growing revenue at the analyst consensus here of 30% for the first 2 years, and assuming with tariffs and a little bolster, and they continue growing all the way up comfortably to about 4.2 billion in revenue is where I think is a base case strong revenue they can get. Free cash flow in 2024 was 22.22%. And actually, analyst consensus is moving downward here, 19 and 21% in 25 and 26. But then, we'll have it building back up at 20% here for 27 through 2031 to be a little more conservative, and then 22% even still being conservative and under the 2024 amount. I think they can get higher, but again, I want to kind of show a more conservative approach. The mid-year convention at 10%, 1 divided by 1 plus zero point 0.1 raised to the zero point 0.5 will get you that mid-year convention that takes into account the time value of money and the risk of your investment. Mid-year, because it's raised to the zero point 0.5. The present value of these cash flows, right, the 185 times the 95% is 177, with these first couple of years totaling about 2 million or so, 2.1 million. Real quick, if I add that, then 76 million there in the terminal, right? This is where the bulk of everything is coming by. We're saying into perpetuity in the terminal year, this is how big it can get, and then we'll grow only at the rate of inflation. So you get 7.6 billion there from the terminal, about 2.1 when you add all these up, 2,100. It gives you about 9.7 billion with about 515 billion in cash that could be taken out or used to put down on debt. I did see an updated debt figure in their shareholder Q2 disclosure of about 25 million, sorry, and that gives you an enterprise value of about 9.2 billion. They have about 169 million shares for a target price of $54.4 and $36.83 is the current share price with a margin of safety about 48%. So I think it's a really unique company, super high growth, reasonably valued. And, with the strong guidance going forward and looking at it, from a discounted cash flow perspective, I think it's a solid time to buy the stock.